For months, India's textile industry has been under intense pressure. When the US imposed steep 50% tariffs in 2025, orders slowed, margins collapsed, and factories cut back production. The knitwear hub of Tirupur alone is estimated to have lost around 15,000 crore rupees last year. But now that picture may be shifting. India and the US have finalized a new trade agreement that brings tariffs down to 18%. So does this deal merely repair the damage, or could it actually change India's position in the global textile race? To understand that, we need to step back and look at the global textile map. Who dominates it today, where India and its rivals stand, and what this tariff cut really changes. Global textile and apparel trade is currently valued at around $800 to $900 billion and could cross $1.2 trillion by 2030. China remains the clear leader. In 2023-24, it exported over $260 billion worth of textiles and apparel, accounting for roughly 30 to 40% of global trade. India, by comparison, exported about $36.6 billion in FY25, giving it a global market share of around 4%. India's strength lies in diversity, from cotton yarn and fabrics to garments and home textiles, which gives buyers multiple sourcing options. But its closest competitors are Bangladesh, Vietnam, and Pakistan. Under current US reciprocal tariff structures, exports from Bangladesh and Vietnam face duties of around 20%, while Pakistan stand at roughly 19%. Bangladesh exports more than $50 billion worth of garments each year, accounting for about 7 to 8% of the global clothing market. However, the sector is under strain. Political instability, labor disruptions, and the gradual loss of duty-free access as Bangladesh exits the least developed country category are raising questions about supply reliability. Vietnam ships close to $40 billion worth of apparel annually and holds around 9% of the global market. But rising labor costs and heavy dependence on imported yarn and fabrics are squeezing margins and limiting pricing flexibility. Pakistan exports roughly $17 to $19 billion in textiles each year, or about 2% of global trade. Persistent energy shortages, high production costs, and supply chain bottlenecks continue to constrain growth. Now, in global sourcing, brands rarely rely on a single country. When several suppliers face disruptions at the same time, even a small cost or tariff advantage can shift large volumes of orders. India currently exports close to $11 billion worth of textiles and apparel to the US, its single largest market. Industry projections suggest that even a modest shift in sourcing could deliver double-digit export growth to the US over the next few years. That would support India's push towards its $100 billion textile export target by 2030. But tariffs alone will not decide the outcome. Global brands still choose suppliers based on scale, delivery speed, reliability, compliance, and technology adoption. And these are the areas where India will need to move quickly if this tariff advantage is to translate into lasting gains in global market share. Follow Business Standard for more stories.